What's up, everyone? It's Kadi with Money Investing. So, a lot of consolidation for the markets once again today. A little bit of rotation out of big tech over to more value oriented stocks, and a lot of the banks actually did a lot better today as well. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below. Consider supporting and joining our Patreon community, where we have a little bit over 3,700 members talking about fundamental and technical analysis pretty much all the time, as well as stocks and options. And there is a 16% discount that you can take advantage of on an annual basis, and that does expire at the end of this month with very limited spots available. So you'll also get access to all the buy and sell alerts, options alerts, trade ideas, all that stuff is included. Link is going to be down below. So first things first, I would encourage everyone to go check out my other video, which is going over the 10 questions that we need from Jerome Powell and the Federal Reserve. So these are a list of questions, or pretty much call it a list of guidelines or framework that I think we need to have it addressed by Jerome Powell. Not that I'm gonna, present it to him at the meeting, but when he's talking, when he's answering questions, we need more color around those 10 things, right? These are all going to be around the Fed's balance sheet, interest rates, inflation expectations, employment, the new funding program, the banking crisis. All of that is covered. So definitely do check out this video, especially prior to the Wednesday, March 22nd meeting, so you have a good idea on good guidelines and frameworks on what we're looking for in terms of what needs to be discussed and what the market really needs answers to when it comes to certain things, certain topics. Now, Amazon to lay off 9,000 more workers in addition to earlier cuts, and that is now getting up to 18,000 staffers. If you count the rounds from back in November and extended into January, which affected more than 18,000 people. And I'm going to break down the layoffs.fii in a separate video, and I think that number is now over 200,000 already so far in 2023, and all of last year I think we were at about 225,000 or so in layoffs. So we're already getting up to pretty substantial numbers for the number of layoffs that these tech companies have done in 2023. Of course, a lot of them coming from Meta, Amazon, Google, Microsoft, a lot of these companies, Apple with cost cuts. There's been a lot of big tech companies cutting down on the cost because of what's happening in 2023 with respect to the macro backdrop. Now, this right here, the $17 billion wipeout of Credit Suisse bondholders has not gone down well in Europe. I actually did a video on them earlier today talking about COCO bonds, and those are convertible, contingent convertibles. That's what it's called, COCOs. And I know Wall Street has the most crazy and the most exciting names for their financial instruments that they create. But the bottom line is that the Swiss national government, or the Swiss finance minister, decided to write them down to zero, pretty much. And these are called additional tier 1 bonds, AT1 bonds. These are the riskiest types of bonds an investor can basically purchase because they're high yielding, and they were written down to zero, so by wiping out close to $17 billion, which also created some panic and some anger in the AT1 bond market over in Europe, Asia, and of course North America as well. So Swiss regulator FINMA announced Sunday that so-called additional tier 1 AT1 bonds, which are widely regarded as relatively risky investments, will be written down to zero as part of the deal. What's also interesting is that they actually jumped the queue ahead of the stockholders, pretty much equity holders jumped the queue ahead of bondholders, and therefore the decision, quote, can be interpreted as an effective subordination of AT1 bondholders to shareholders, and it also represents the largest loss ever inflicted to AT1 investors since the birth of the asset class post-global financial crisis. So pretty substantial loss of $17 billion for Credit Suisse AT1 bond holders. And moving forward, demand for the Fed help shows the banking industry is still under pressure. So a lot of it is riding on Jerome Powell's speech on Wednesday, March 22nd. That's exactly why it's so important for us to have a framework, for us to understand exactly what Powell needs to address during that meeting. And Danielle DiMartino, CEO of Chief Strategist and Quill Intelligence, said, and I quote, "Right now we are in a sea of the unknown. The uncertainty stems from just how much help the financial sector needs and how deep the problems penetrate." In normal times, a trip to the discount window carries a stigma, an indication that customers are in some sort of financial trouble and can't go through normal market routes to raise capital. So, one of the things that I learned in school was that the Federal Reserve was the lender of the last resort. That's what they're called. That's literally what they are referred to, lender of the last resort. If the bank cannot raise capital any other which way, they would go to the lender of the last resort, which is the Federal Reserve, to the discount window and borrow it at the discount rate. Now that's what's happening. We've seen about 150, close to $200 billion being borrowed by banks. The Fed's balance sheet has swelled up, and they have again printed money, and they have lent that money out to these banks. So that definitely has a stigma attached to it that there are problems and the banks are still under pressure. It's just a matter of timing. It's just a matter of liquidity, and it's just a matter of capitalization, right? So are these banks well capitalized or not? And if they do actually get into trouble with any of these bank runs or withdrawals, obviously things can get much worse. I did a video on the research paper that was published. That was very, very interesting. Definitely check that out if you have the time. But right now, as it stands, we've got $2 trillion of securities that are underwater in terms of the market value with respect to their book value, and about 190 banks that are at severe impairment risk at the moment, given how high interest rates have gone up. So there's a lot of things. I mean, this just goes way too deep than what we already know with the entire banking system. So definitely we need to be on the edge. We need to be on our toes and pay attention to what's going on with certain banks. And programs such as BTFP can have that stigma too, but in that case, the Fed is making its conditions a bit easier than the discount window, because it is really just, and this was something that they mentioned, which I think kind of resonated with me. It was a very, very good analogy used. The discount window takes everything. You bring us your garbage, we'll give you a haircut, and we will send you a lifeline, but it's going to cost you. That's literally it. The banks are bringing the Fed their literal garbage. Literal. I mean, these are bonds and securities we're talking that are so underwater in losses, and the Federal Reserve doesn't care. They're taking them up at face value, giving them a 10, maybe 20%, or not 20%, maybe like a 5 to 10% haircut, and giving them the money that they need, giving them the funds, and it's absolute madness. We have seen the largest uptake in the discount window in history. That takes out the financial crisis of 2008 highs, which is a sign of severe liquidity strains in the banking system, which will manifest hugely impaired credit creation as well. Right, so it's a lot about money. So it's all about credit creation as well, because if a lot of the banks are undercapitalized and they're borrowing from the discount window in order to be capitalized, they're paying the higher rate, 4.75%, but they're not lending that money out because they need to increase their capital ratios, right? So they need to raise capital in order to maintain those capital ratios. So whatever they borrow, right, they don't lend that out. That becomes a problem in itself from a credit standpoint. But if they do lend that out, that becomes a problem from an inflation standpoint. So, right now we've gotten into a situation from the markets and the economy, the banking sector, is that whatever you really do is just not good in one way or another, because we've just gotten up to an extreme with the banking sector. There was another report from CNBC, or I think it was Market Watch, that pretty much mentioned that Warren Buffett's Berkshire Hathaway, the safest place to be amid all this uncertainty. And I think there's been sort of like this misconception that investors need to look for stocks in order to kind of ride out this volatility. But there's another level of risk that has just piled on over the last couple of weeks, and that is simply based with your deposits, right? So I was thinking to myself, I was like, okay, this article says that Warren Buffett's Berkshire Hathaway is the safest place to be amid all this uncertainty. But what if you are investing with a broker, or let's say, a bank that fails, that goes under, right? Then you've got no risk. Even though you are in Berkshire Hathaway stock, you've invested with a broker or a bank that potentially could fail. So there's no safety there. So that's what I was thinking. Like, it's not so much about stock selection and risk aversion in the markets. It's also about risk aversion with literally the most basic thing, and that is where to place your money, where to actually keep your deposits, right? That's the risk the markets are also carrying now, which is quite crazy to think about. Your deposits should almost always be safe, but that's not the case right now. Anyway, Microsoft here down 2.5%. Google, Intel, AMD, Amazon also pulling back. So a little bit of big tech, rotation out of big tech over to energy and financials and healthcare and some of the other sectors out there. So overall, the markets were green, very much pushing higher, except for NASDAQ, which was, I think, flat or slightly down on the day. Actually, slightly up 39 basis points, but still obviously pulling back. Semis and big tech were the underperformers. This is, again, the entire market. So consumer cyclicals, a little bit of software application. We got tech, and of course, a little bit of semiconductors, Intel, AMD pulling back, with an energy, industrial, real estate, healthcare, financials, all sectors doing great. So all 11 sectors in the S&P 500 were green. Over the last 1 week, we've got comm services, technology, utilities, defenses pushing higher, with energy rotating back down. And in the last 1 month, comm services is the only sector that is outperforming at the moment. Everything else is straight up down right now. So feeder cattle, cocoa, and coffee prices pushing up, with orange juice, lumber prices, lean hogs, and live cattle pulling back, and Bitcoin just a nudge over 27, actually a little bit under $28,000, and Ethereum just over 1,700 at the moment. Now, the bank panic of 2023 could be just what the stock market needs to make money for investors again. This is another headline that was ran by MarketWatch, and I actually mentioned this in our Discord earlier this morning, that we unfortunately live in a world where the economy has to blow up and banking system has to fail and unemployment has to go up in order for the markets to feel optimistic and be optimistic about the future. It's kind of crazy, isn't it? Like, if you think about it logically, right? Everybody who's just vouching for quantitative easing is really, I mean, that just goes to show the market's psyche into how addicted the market and the economy has become over time, how conditioned we have become for quantitative easing, right? I mean, it's like bank panic of 2023 could just be what the stock market needs. Really? Like, really? People losing their deposits, unemployment rate skyrocketing, is that really what we need? Like I said in my live stream, can't we actually for once grow on a more real basis, like actually see some real growth, except for all this money printing and QE and manipulation? It's been frustrating for me, and I don't know if it's coming across the right way, but it has been really frustrating covering all of this in the last couple of weeks. It just hurts. It's really sad with the entire system. It really is. I can't, it's been really sad going over all of this. There was another article here. The end of everything bubble has finally hit the banking system. Credit Suisse and SVB might be just the first of many shocks. So feels like a ticking time bomb for a lot of people, and maybe I will do a video on this as well. And what the future might look like with respect to the dollar and of course a lot of the currencies, because we also talked about the US dollar swap lines being open for a lot of central banks around the world, and the Federal Reserve is going to once again start printing and lending that money out. Now, this is one quote that I have talked about this for a couple of years now. I've mentioned this. You may not have heard of me saying this, but it is so important for you to always remember this. I'd rather be conservative and right than be aggressive and wrong. I think there's so much value in that quote, and the reason is because you can always dial up on the risk in the future. Just like I thought of an analogy here today, and hopefully it's good enough. But let's say that you're cooking something, right? And you have to mix all these ingredients together, right? Now, when that happens, right, so what I've always thought of, or what I've always done, is that I would put in a little bit. Let's say you have to put salt into something, right? I would put a little bit of salt, taste it, and then I can always put more, right? But you can never go back. Once you've already put too much salt, you can never go back. You have to start again, right? You can never take small grains of salt out of your dish or whatever you're making, but you can always start small, or you can always start with a little bit and always add later, right? I think that is a big that's an analogy, by the way. So going back to what we talked about, I'd rather be conservative and right than be aggressive and wrong, is a simple analysis of why start with your aggressive approach, right? Why start with an aggressive analysis? And I think a lot of banks, the problem is that they always go with they don't go with a conservative estimate, or they don't go with a modest estimate. They always go with the riskiest possible thesis and the aggressive, because they're in the search for yield. They're in the search for where can I, generate that net interest margin. And when you're wrong with those bets, the outcomes are catastrophic, right? So like I said, I'd rather be conservative and right than be aggressive and wrong, because this can be catastrophic, and this can definitely put you on the right path. And it's it's a lot about staying in the game. It was in that book, Psychology of Money, from Morgan Housel. It was all about staying in the game. It was not about beating the game every year, every month. It was not about doing better than the next person. It's a lot about staying in the game, because eventually the markets will give you favorable conditions for you and you will be able to do well. But if you blow up your account and you're just like out of the game, like Silicon Valley Bank is now, like Signature is now, you've got nothing left, right? So it's all a lot about staying in the game long enough for the market conditions to be favorable for you to do well. And the way you do that is by being conservative, being on the more conservative side, than being super aggressive. And then, of course, if God forbid you're wrong, then of course you end up blowing up your account. So, definitely let me know what you think about that. Wanted to mention it. But anyway, so going back over to the markets here, volatility coming down over 5%. So definitely selling off quite a bit, trading a little bit over 24. So last few days we've seen volatility kind of spike back up, down, lower, all over the place. It's been back and forth here. And crude oil prices, we are recovering back up from that support that we talked about. So $65 per barrel, that's been a support for crude oil. We're seeing a little bit of momentum back up from those levels. And then Ethereum, a little bit over 1700. So this is going to be considered as a support for Ethereum, sitting right here at 1738, 1740 levels. And then Bitcoin is also just a little bit under 28,000. So that is a resistance for Bitcoin. So Ethereum's kind of coming down to a support. Bitcoin's coming up to a resistance. Right now, we're kind of at those levels. And crude oil also getting a bit of a bounce from a support, with volatility coming right back down. With respect to the yields, we have seen them push back up a little bit. And this mostly happens when there is a bit of a supply in the bond prices. So bonds sell off, yields stabilize, and they go higher. And right now, that's what we're seeing with the 6-month back over 4.8%, the 3-month back over 4.6.5%, and the 10-year sitting at over 3.483%. So pretty much flat so far on the day. Talking about S&P 500 now. So SPX, what do we got? We did see a green day, green candle, lots of momentum, 90 basis points pushing up. So very nice momentum to the upside. We've got a resistance and a target up to 4,100. It's possible that we get up there. Again, a lot of it rides on what Jerome Powell has to say on Wednesday. But that is going to be a resistance to pay attention to at 4,100. And a support level staying put at roughly 37.75 for S&P 500 moving forward. Talking about the NASDAQ, again, very similar situation. Green day, green candle, pushing higher, very good. 12,280 is going to be that next resistance to watch for the NASDAQ. And of course, we got a support sitting right over here at roughly around 11,000. That's the previous resistance. That's where we have gotten rejected at in the past. And right now, we're seeing a little bit of momentum back up, of course, from the NASDAQ index, from tech stocks. Tech stocks have, in fact, outperformed the S&P and the Dow for 11 straight days. And of course, today was a little bit of an underperformance as you saw that rotation back out. But again, a lot of it rides on what JP has to say on Wednesday. Talking about Apple here, Apple on the day also starting to break to the upside. So we talked about this inverse head and shoulders, right? So a little bit of left shoulder, head, and right shoulder, the neckline, and we're now starting to creep back up this potential inverse head and shoulders. And if we do see a breakout about 158, which is going to be this resistance right here, it's possible that Apple continues to charge higher, and that next resistance is going to be at 165 to as much as 177. That's almost going to be its all-time high, 177 to 181, pretty much going to be back up to its all-time highs. But right now, we are seeing a very nice break to the upside from this inverse head and shoulders. Talking about Amazon, so Amazon on the day down 1.24%. After hours, also very, very flat, so not really seeing a lot of momentum after the job cuts, but we are seeing a lot of consolidation sideways in this range, or in this consolidation pattern that we talked about in my previous video. And right now, just getting rejected at these lower highs. So that is going to be that next level that's sitting roughly 106, 107 for Amazon moving forward. Talking about Tesla back up to 183, up a little bit over 1.7%. So seeing a lot of momentum back up. Resistance is going to stay put right over here, sitting roughly at $200, $203 per share. We have gotten a couple times rejected at that level, all the way up to 220s to 228. So this right here is also going to be that red rectangle to watch for Tesla, sitting right over there. So a couple resistance levels that Tesla needs to battle through before we can see some more upside, some more momentum for this company moving forward. Talking about NVIDIA now. NVIDIA still green on the day, up over 0.68%. So sitting right above $259 dollars per share here, so closing in right on the dot. Resistance next is going to be all up to 291, so this right here is going to be that next level to watch for Nvidia. And of course, we got a higher high and a higher low sitting right over here. I mean, it's been trading inside this uptrending channel for a long time, and we're still starting to break to the upside. We're kind of having this break the top off rally, so to speak, and 292 is going to be that next resistance to watch for Nvidia. But again, incredibly overvalued in my opinion, and definitely getting up to overbought levels. Same thing with AMD here. RSI is over 72. MACD has been pushing higher, and we've consistently been trading inside this higher high and higher low pattern, kind of testing this higher high at the moment. So we'll continue to monitor whether AMD actually breaks to the upside, has this blow the top off rally, or starts to get rejected here, starts to roll right back over, right? So I did a video on technicals over the weekend. Make sure that you do check that out. Next up, we're going to talk a little bit about PayPal. And PayPal here on the day was up 30 basis points. We're seeing a lot of consolidation for PayPal, so it's not really moving much except going sideways. And the next resistance really is going to be the 79, close to $80 for PayPal. That's going to be the level to watch. And we've got a support sitting roughly at around $67 per share. Of course, my fair value sits roughly at around $70. That's going to be the fair value for PayPal at the moment. Talking about Square, and Square on the day was up 70 basis points, so green candle on a green day, and we are seeing some lower highs and lower lows, so very, very short-term downtrending channel. And resistance is going to stay put at $83 to $89, so this right here is going to be that red rectangle to watch for Square, and support level is going to stay put at 58, close to $59 per share for Square at the moment. So that's going to be that support here. Resistance is going to stay put at $83, $89 for this company. I would be interested in some long swing trading ideas if it does come down to 59, closer to $50 per share. So next up, we've got Meta, and Meta here on the day was green, up over 1%, so still at a resistance, 197, 198, pretty much at this level here. So that's the horizontal red line that we've been talking about for Meta, still in a pretty good uptrend, making higher highs and higher lows. And the next target is going to be up to 222, so 222, that's going to be the level to watch for Meta next, if and when we get a breakout past 197 for this company. Talking about Netflix here, and Netflix on the day was up 0.5%, so we are still expecting a little bit of a bounce back higher from Netflix, considering how oversold it is, and we are starting to see a bit of a crossover for the MACD above that signal line. But of course, we are definitely trading below this higher low, which can be considered as a bit of a resistance now. That's exactly where we seem to be getting rejected here for Netflix. So again, continue to monitor this. Support level is going to stay put at 276. Of course, my fair value is a lot lower than where it's trading right now. Talking about Google here, and Google on the day was down about 0.5%, still continues to push through. Again, this was a perfect trade idea that played out. If you want to get access to all those trade ideas, buy and sell alerts, options alerts, the link's going to be down below if you're interested in joining us. But this is going to be a potential support now for Google, since we are trading above that level at the moment, and the next resistance is going to be all the way up to 104, 105 for Google moving forward. So that's going to be that next level to watch. And last but not least, we got Microsoft and Shopify. Microsoft here dropping a little bit more, pretty aggressively. So again, it was already coming up to its overbought level with the RSI well over 70, 72. Still in a bit of an uptrend, so still making good higher highs and higher lows. 292 is going to be that resistance. That's going to be the level to pay attention to, because we have gone rejected here going back as far as August of last year. And if you do continue to see a pullback, I'm waiting for 218, 220s as a potential buying price for Microsoft moving forward. Last but not least, Shopify. And Shopify very flat, down about 1.79%. This is going to be the higher low to watch for Shopify, and the support's in roughly at around $41, $42, and the resistance all the way up to $54. We've got a gap to fill over here for Shopify as well. So I hope you guys enjoyed this video and a complete update on the markets. Lots to unpack later this week with Jerome Powell coming out and the FOMC meeting. Make sure that you do check out that other video where we talk about the questions that Jerome Powell needs to address during the press conference, and hopefully some of the questions will be asked from the press as well. But let me know your thoughts down in the comment section below. And make sure that you drop a like, subscribe, and the link to our Discord and Patreon is going to be down below if you're interested in joining us and get access to all the alerts, trade ideas, benefits, private videos and lectures, all that stuff. As always, happy investing. I'll see you all in the next video.